When it comes to building wealth, there are two popular strategies that often seem to be at odds with each other: investing and paying off debt. Both have their pros and cons, and both can have a significant impact on our financial health. But which one is the key to making you rich? In this video, we'll explore the benefits and drawbacks of each approach and help you make an informed decision that works best for your financial goals. Investing and paying off debt are often presented as mutually exclusive options, but the reality is that they're intertwined. The money you invest has the potential to grow over time, but if you're carrying high interest debt, it can be like throwing money into a black hole. On the other hand, paying off debt can free up more money in your budget to invest. But if you're not earning interest on that money, you could be leaving potential growth on the table. The truth is, there's no one-size-fits-all answer to this question. The best approach for you will depend on your individual financial situation, your goals, and your risk tolerance. But before we dive into the details, let's set the stage for our discussion. Imagine you're faced with a tough decision. You have some extra cash on hand, and you're not sure whether to invest it or use it to pay off debt. What would you do? Let's say you've got a credit card with a 20% interest rate and you owe $5,000 or 281,056 pesos. You've also got a brokerage account where you could invest that money in the stock market. What's the smart move here? Do you pay off the high interest debt and free up more money in your budget? Or do you invest the money and potentially earn a higher return? When it comes to investing, the power of compound interest is a game changer. And if you invest $5,000 today and earn an average annual return of 7%, you'll have over $38,000 or $2 million in 20 years. That's the power of compounding, and it's a key benefit of investing. But what if you're carrying high interest debt? In that case, the interest rates are working against you, and it might make more sense to focus on paying that debt off as quickly as possible. Of course, there are different perspectives on this issue. Some financial experts argue that you should always prioritize paying off high interest debt, while others say that investing your money is the key to building wealth. So what's the right approach? Well, it depends. If you're carrying debt with an interest rate higher than the return you expect to earn from investing, it usually makes sense to focus on paying that debt off first. But if you've got low interest debt or a stable financial situation, investing your money could be a smart move. That being said, there are some key challenges to consider when deciding between investing and debt repayment. One of the biggest is emotional stress. If you're carrying high interest debt, it can be stressful and overwhelming, and paying it off can bring a sense of relief and freedom. On the other hand, investing your money can come with its own set of risks and uncertainties, which can be stressful in a different way. Another challenge is aligning your financial goals with your investment strategy. If you're trying to build wealth over the long term, investing might be the way to go. But if you're focused on short-term financial goals, such as paying off debt or building an emergency fund, investing might not be the best choice. Market volatility is another key consideration. If you invest your money in the stock market, there's always a risk that the market could fluctuate and you could lose value. This can be especially challenging if you need the money in the short term. Despite these challenges, there are some key statistics that can help guide your decision. For example, did you know that the average annual return on the S&P 500 over the past 20 years has been around 7.5%? That's a pretty compelling argument for investing, especially if you're looking to build wealth over the long term. But what about debt repayment? According to a recent study, the average credit card debt in the United States is over $4,000, with an average interest rate of around 17%. That's a significant burden, and paying off debt can bring a huge sense of relief and freedom. So what's the takeaway from all of this? The key is to look at your individual financial situation and make an informed decision based on your goals and risk tolerance. If you're carrying high interest debt, it usually makes sense to prioritize paying that debt off as quickly as possible. But if you've got a stable financial situation and a long-term perspective, investing your money could be a smart move. Ultimately, the decision between investing and debt repayment is a personal one, and there's no one-size-fits-all answer. The most important thing is to do what's right for your financial situation and goals. Thanks for watching, and don't forget to share your experiences with investing and debt repayment in the comments below. Oh, if you're new here, consider subscribing for more financial advice and insights.